The RBA's forecasted CPI target of 2 to 3% by 2025 is unrealistic. We believe that the expansionary COVID-19 fiscal and monetary policies that have caused the current CPI rate of 7% will be prolonged and further impacted by the federal government's inflationary budget measures. We expect the inflationary pressures will persist and result in a larger, more aggressive interest rate hike of 200 basis points by the RBA in order to curb the sticky inflation. With this recessionary shock implemented into our valuation models, we have identified fair value price targets of $105.33 for Ramsay Healthcare and $27.40 for Woolworths Group. With these price targets, our recommendation is to buy Ramsay and sell Woolworths. Our macroeconomic expectations and impacts of the recession applied in our valuation models justify our stock recommendations. Our expectations are that the unemployment will rise similarly to previous recessions such as the early 1980s and early 1990s Keating-era recession, as seen in the leftmost graph. Furthermore, we expect the economic brunt to be borne mainly by middle and low-income households, which represent 77% of the Australian economy. Increased financial distress will culminate with the sharp decreases in disposable income and consumption, eroding discretionary spending and increasing consumer price sensitivity, similar to previous recessions as seen in the rightmost graph. With these shocks accounted for, Elias will now explain the buy case for Ramsay.
Ramsay Health is a provider of clinical practices. It is Australia's largest private hospital operator and has an extensive portfolio of mental health facilities. 40% of hospitalisations occur in private hospitals, of which Ramsay dominates given its market share. There are numerous external drivers that support our buy case for Ramsay. Mental health disorders, substance use, alcohol intake and suicidal behaviours increase in a recessionary environment. The unemployed and individuals with financial difficulties are most vulnerable. Mental health issues disproportionately increase. Ramsay has grown its presence in the mental health sphere over the last decade, represented through its most recent acquisitions and promotion of a mental health executive. We believe Ramsay is primed to meet the increased demand for mental health services arising from a recession. Ramsay has also partnered with governments to extend its infrastructure to the public system, further bolstering its presence and capturing the increased demand. 83% of patients admitted to private hospitals are funded by private health insurance and is a key funding source for Ramsay. In a recession, households may reduce expenditure by cutting private health insurance. However, historical data suggests that despite economic headwinds, membership to private health insurance has grown consistently. As such, it is reasonable to suggest that funding sources for Ramsay will not be impacted by a recession and the public-private mix will be maintained, albeit with high demand for patient care feeding into Ramsay's bottom line. Further demand-side pressures come from the current macro health environment, strengthening our buy case. An ageing population, rapid increase in migration, and the overall health of Australians will shift the demand curve further to the right, flowing onto Ramsay through the public-private mix. Sales growth represents the average growth over the last 10 years. We have conviction that the forecasted rate is justified given the current and imminent public health demands. The estimated share price is reflective of the economic shock through the WACC and cost of debt. Given the increased risk of leverage, cost of equity has also increased. We expect growth to taper by 2033 with a terminal growth rate of 2% given its maturity and acquisition ceiling at the time. I will now pass it to Jacob to make his sell case.
The Australian grocery and consumer staples sector is worth approximately $130 billion. The sector has historically been less sensitive to economic cycles. However, the rapid emergence of discount supermarkets such as Aldi, Costco, and online retailers such as Amazon Pantry have challenged the market share of premium supermarkets. Currently, 43% of Australians cite grocery expenses as their most concerning expense. We expect consumer behaviour to reflect increased price sensitivity when purchasing discretionary and staple items. Price data indicates that shopping at Aldi can lower the average cost of groceries between 43 and 54% over premium supermarkets. In our forecast of recession, we expect discount competitors operating lower cost business models to attract struggling low and middle income households away from premium retailers, impacting their growth. Our view is that the current share price is overvalued and fueled by the mandatory COVID-19 changes in consumer behaviour resulting in record profits for Woolworths, which has now eased. Coupled with increased price sensitivity of struggling households and the market competition from discount retailers, we expect the group to experience reduced growth well below market expectations, as reflected in our low sales growth forecast. The effects of the Endeavour Group demerger have also been factored in this forecast, in addition to our expectation of the sharp decline in disposable income diminishing discretionary and premium item sales across the group. Woolworths' debt is set to current market rates, and we expect this debt provision to continue. The group has a high debt-to-assets ratio, indicating a high level of debt. The cost of debt has been increased from 6% to 8% to reflect a 200 basis points rate increase, resulting in high interest expenses. The cost of equity has also increased by virtue of the increased risk-free rate, and both of these factors have led to a higher WACC of 8.38%. Davida will now conclude our Woolworths valuation and investment report.
Thank you, Jacob. This sensitivity analysis and share price graph of our valuation indicates that the WACC and terminal growth rate can deviate from our forecast and still represent a sell case, similar to our base case valuation. Our valuation indicates a 30.56% downside from the current market price, implying a fair value target price of $27.4, and hence a sell recommendation. To conclude, due to the macroeconomic impacts of the recession shock, we issue a buy recommendation for Ramsay Healthcare with a price target of $105.33 and a sell recommendation for Woolworths with a price target of $27.4. On behalf of our whole team, thank you for your time today.